I will invite you now to join this panel discussion exploring how high impact brings high returns and why now it's the best time to invest in urban tech. And for this, I will need our experts, and Hans van Houwelingen will be with us. He's a managing partner at Urban Impact Ventures, Michal, principal at VentureFriends, Shaun Abrahamson, managing partner at Third Sphere, and panel discussion moderator José Miguel Salazar Hernandez, manager Central and Eastern Europe ESG Hub at PwC. The stage is yours.
Hello, everyone. Good afternoon. Apologies for the slight delay. We were actually in the middle of the conversation, so we were like preheating what we're going to talk here. Some opening words, context, and aided by some notes. The global construction sector is an inflection point and a very important moment of transformation by both unprecedented challenges such as the imperative to decarbonize and also address climate-related risks, move towards adaptation, mitigation, and broader sustainability development related. Transforming the urban sector and cities will require fundamental change and innovation, which goes beyond from an impact perspective. It can also represent attractive and numerous commercial opportunities. Going from design, planning to material selection and construction methods and building operations. In this space, particularly climate tech, deep tech, urban tech present very interesting opportunities. Today we have like a very interesting mix of views, various investors, venture capital, different experiences inside of CEE, Poland, out of CEE, various levels of stages. So yeah, to start the discussion, we have one big question, like how does high impact brings high returns, and why the time is the right one right now? And we'd like to open the discussion. Maybe start with Michal.
Thank you very much. Yes, welcome everyone. My name is Michal. I'm a principal with VentureFriends. We are marketplace and fintech investor focusing on European startups. Speaking of high impact, obviously this has been top of our agenda, even though we are not per se an impact fund. We focus more on business model related thesis and so on. However, what we see those days, even though we are not doing it on purpose, we see more and more great opportunities in circular economy, in sustainable energy and so on. So this is there is definitely a market-related pain being solved by startup as a growing scale, and also constantly improving quality of founders tackling those problems. So there is definitely great momentum happening, and also coming from this more generalist investor perspective, we start more and more frequently see, and also it becomes growing portion of our deal flow, the impact investment, especially in green transformation.
Hi, Shaun Abrahamson, Third Sphere. We do early stage climate. We're about 10 years in. I think the moment that we're in is interesting because I started investing 17 years ago. My first investment was in healthcare. And the smartest people that I talked to at that time basically said, this is a terrible idea. And my favorite thing about climate, starting 10 years ago, I got the same reaction, which was, this is a terrible idea. A lot of people just lost a lot of money. And the interesting thing right now is I think there is a lot of excitement, I think, about climate and sustainable investing, but probably for the wrong reasons. I think there's an assumption that somehow people want to do something positive. And I think fundamentally people are still quite selfish. But what is sort of unique about this moment is that we've never had so much technology getting cheaper and better at the same time. right? So batteries are the obvious ones. Solar is obvious. We don't think about the fact that like 10 years ago, we generally didn't have these, but the stuff inside this is kind of remarkable. I don't know how many cameras you have on the back of your phone. I have 3 now. I used to have 1. And that's pretty transformational. Like the physical hardware that we rely on allows us to do things that 10 years ago was science fiction. And I think that's probably the biggest disconnect. If I think about why climate is exciting, it's because China made major policy changes 15 years ago that led to cheap hardware. And again, not a popular idea, but I think that's why the moment is super unique. You can literally pick 90% of the economy and go and ask the question, why has no one done anything very innovative in this industry for 50 years? And you'll almost always find a founder who's like, hey, actually, you know that $100 million cement plant that everyone keeps building? I have a $5 million version of that. Would you like to invest? I'll stop there, because I know we talked.
Very fascinating. Hans?
Sure. Good afternoon, everybody. My name is Hans van Houwelingen. Thank you for still being with us so late in the evening. I spent around 25 years in the investment industry, mostly in the traditional world of investments. And since 3 years, I'm managing partner of Urban Impact Ventures, which is a small boutique venture capital firm with a strong impact connotation around decarbonization and circularity in the urban environment. So a great crossover with the theme of today. I think the question, how does impact also bring high returns in urban tech? I think we heard enough already in the last 2 days about why cities are at the center of a sustainable transformation. And I think around 5 or 6 trillion is required to get us anywhere close to the Paris Agreement. That means a lot of money is required. That also means a lot of investment opportunities are there. And I think over the last around 11, 12 years that I'm focused on sustainable investing, we've had the pleasure to be in the top of the peer groups, so I think I have no doubt about returns being possible there. And I think also the LPs that give us trust today are very happy. I think one point I would like to make about the alignment, because you hear a lot about impact investing and venture capital and great returns. We promise normal venture capital returns to our investors. We can earn, of course, a performance fee. If we do well above a certain threshold, we get a carry. But we can lose half of that carry if we don't make our impact objectives, which is kind of an asynchronic risk that VCs normally don't take, but it shows actually our own commitment towards our investors that we believe in this thesis.
Can you share, what are you tracking for impact?
That's enough for a whole different panel. Yeah, but I'll elaborate on that with the regulatory part. Yeah.
I would like to actually take it from one point that you were mentioning, Hans, which is basically the cost of the transition, which is the same as an opportunity, an addressable market, especially in the context that as the world is striving to move towards net zero, all the various pledges from corporations, financial institutions, cities, nations. How do we get that market size right? Like, how can founders get that right? And again, venture capital, private equity, because there's one extent that can be covered by this. And then there's another extent that could be public sector, private partnership, bigger institutional capital. But we'll be keen to hear more like from them. Venture capital.
Well, I'm very critical on all these pledges of CEOs that won't be in their position 20 years from now, but still pledge. I think most important is that when you pledge, that you also show your progress immediately, year by year, on how you're going to get there somewhere far away in the future. And I think there's still some gaps in that space.
Yeah, like that's a good point about market sizing, and from founder perspective, it's super challenging to actually figure out how big this opportunity can be. Like, for example, we recently looked at this platform for used EV trading, which sounds a bit like a small market today. However, based on all of the underlying market trends, being EV adoption and also circularity of assets, those are powerful forces that eventually can build almost from scratch a huge market of used EV trading, inspections, and so on. So obviously it's good to look from like the smallest component blocks on what will drive different dynamics and how this can be quantified. And also important part to bear in mind is competitive landscape. So we see in decarbonization and in green transformation that some verticals attract way more companies than others, and many of them are vastly underserved. So obviously bigger opportunities lie in the areas which are not as crowded. Easier said than done, but yeah, definitely something for the founder to have front and center.
Yeah, I think the easiest filter for us about whether we're talking to a founder who is serious and has thought about impact is they should be able to show up with a techno-economic model, especially if you're doing hardware, where if I move the assumptions around a little bit, my unit economics will be better than the incumbent. In other words, there shouldn't be a green premium. Like we are not going to do that investment. Anyone who tells us as a customer that they will buy and pay a green premium, we assume they're lying. And so our default behavior, I think I'm very skeptical of the same public pronouncement. What we've seen over and over again from sales teams is that when you eventually get out of the meeting and have your third drink, in California we do mushrooms, but once you have mushrooms, you get the truth, which is my CFO isn't going to do this. We may do a token amount and we'll do a pilot, but you're not going to scale. And so that became the hard test for us, is if you can see a model where, like we just looked at a textile recycling company, the magic part of the techno-economic analysis is that they do enzyme design, and you can see the plot at which they become better than virgin cotton. And that's the point at which we say, okay, like we'll take the risk that it takes 2 years to get there, but there's no point in doing it if you can't beat the incumbent model, because we just don't see a way to scale. So that's kind of the discipline. I think the hard thing is it feels terrible to say that you don't trust public expressions, but that is reality. Like I think over and over again, my sort of final test on this is I've driven an EV for about 10 years, and to embarrass my kids, every time I get out at a supercharger, I'll walk up to someone who just bought a new car, and in California you can see because they have like a paper license plate, and I'll knock on the window and say, how do you like your car? People will say a lot of things. They like the acceleration, they like the screen, they like not paying for gas. There are 0 people who've ever said, I'm happy I'm saving the planet. 0. And I just think that's reality. If you catch people off guard and they tell you why they buy things, it's still pretty selfish.
Well, it's also very challenging, like to bring the big macroeconomic transition down to the personal level. And on that note, actually, we at PricewaterhouseCoopers recently published our latest analysis on the state of climate tech. Volume activity in terms of venture capital, private equity investment, merger acquisitions down by more than 50% year on year. We look at climate tech down 40%, of course still down, but we'll sound that there's more attractiveness to certain type of investors. I think to the extent you will cover those definitions. We'll be keen to hear, like, from your perspective at this particular time, looking at the macroeconomic environment and everything going on. Why is the time now, like 2023? Yeah, or what do you see, like, let's say, for the coming near-term future?
Okay, I'm going to not talk too much, so I'll just do a short version. I think in the physical environment, the thing that we will talk about the most in 3 or so years is physical risk. And so when we started 10 years ago, our climate framework wasn't the IPCC, it was C40 cities, right? And the reason was, it was a ridiculously high-level detail for every kind of pathway, but it also had physical risk. Not that we've actually done a lot of the work, but there was at least a framework. And somehow that just isn't in the conversation. But what changed in the last 12 months is that the reinsurance business is in the process of probably pricing climate risk. So if you look at like the state of Florida, insurance costs are up 300%. And that is going to introduce a different kind of conversation. We're doing, some investing there, but we haven't had, in the same way that carbon markets maybe are supposed to signal, green premium, we haven't had a physical risk signal until probably the last 6 to 12 months. So we expect to do a lot more in sort of physical risk. I'm not going to waste the time to say what that looks like, but as a category, we think adaptation and resilience is much more interesting than it has been.
Yeah, well, first of all, Shaun, in Amsterdam, we just take the drink and the mushroom and whatever we can find, and we just blend it. And we have very great conversations.
That's why you did physical risk.
Yeah, that's physical risk. No, I think, if you want the sustainable transformation of our society and maybe, cities at the center of that to succeed, you have to make it economically relevant. And I think, if you take that statement, then I fully align on one of Shaun's first comments about, the techno-economic model. We also saw that with a proposition we're looking at the moment, which is in reused concrete. Concrete is one of the most intense, carbon footprinted materials that is being used in construction, mostly because of cement. And what you see now is that reuse of rubble is going up to 80%, which is very high. So you can use almost 80% of rubble to make new concrete. But the most advanced technologies today are actually producing a better product than the virgin product, because the stones that are taken from the rubble have better surface characteristics, need less glue in order to make new concrete, and actually it's much more robust. So the secondary product is better than the primary product, whereas the feedstock coming in, the rubble, is kind of free or very cheap compared to buying raw materials. So these companies that are at the forefront of innovation are actually ready to take out the incumbents. And at the moment you can find investable propositions that have these characteristics. I go back to the theme of today. You can have outsized returns while having a huge impact, because reusing 80% of rubble is an 80% reduction in carbon footprint for new buildings.
Yeah, I think to answer your original question on the discrepancy in how the general market has declined versus how green economy has declined, I think key driver why we saw this magnitude of contraction is coming from the confidence in the markets and how subsequent funding rounds and eventually exits can be materialized. And obviously with IPO market non-existent, there isn't that much confidence. However, for green economy, this dynamic is quite different, or the extent of this is much smaller. And obviously we might not believe in every single pledge that we hear. However, even if the governments or corporations fall short of the objective, which most likely they will, the directional confidence, I think, is shifting the sentiment of the market towards those companies which are working in this space, and there is growing amount of conviction that there will be somebody to, if the company is executing well, to take it to the next level and eventually to buy it out, because it makes sense also from practical point of view, and there is too many stakeholders who are willing to take it up. So yeah, some of them might not deliver at all, but in all, I think it's a very positive development.
Thanks. And maybe we'd like to take a brief pause. We actually have some time for questions from the audience, in case you have any. All right. Well, in the case of what you were mentioning, Michal, on the exits, this is quite interesting, because to a certain way, if we will call it as an asset class, let's say impact startups or climate tech, it's quite new in the space. There haven't been that many exits, you could say so, but maybe we'll begin from your perspective. What have you seen as exits, or what would you foresee as could be, let's say, the type of exits, like if they will go to sold for larger private equity funds, corporates, perhaps the incumbents that they are like acquiring the startup and merging into operations, leaving it open.
I mean, I think it's probably still a little early to see exits. Like I think a lot of like for the companies that we have that are coming up on 10 years, most of that is M&A, right? So like we have a lot of connected devices. We have like transportation and mobility. I think like the traditional mobility from an automotive perspective, you can start to see that they are buying things like e-bikes, which is not, that is a relatively new trend. It's unclear if that will last. There are transportation services companies that are looking to buy sort of microtransit or EV fleets and things like that. So we see some of the interest in, I think, incumbents, trying to jumpstart their own, let's say, electrification generally is the trend. But it's still a little bit too early. I think the challenge in VC is that most of our fund, like if we make, let's say, 20 investments, there's really just one company that actually defines most of the economics and actually probably most of the impact, right? Like if we look across, the impact dynamics look very simple. And that's usually going to be through an IPO, not through M&A. And the only bad thing that I see currently is that we did all these SPACs in the US with really BS companies. Like these were fake nonsense, essentially very cynical investors offloading to retail investors, and most people lost money. And I think that's going to be something that we have to defend. Like you're going to need really high growth, very, very obviously successful companies that can restart the IPO market. That's probably my main concern, is that that's probably 1 or 2 years out. Because the SPAC frenzy has done a lot of damage.
We're a young fund, so we don't have exits. But of course, when we make an investment, we already try to think through what the exit might be. We try to diversify in our fund over the levels of the horizons of innovation. So we have some investments in companies that do something a little bit better than what is already there. We have investments in companies that come up with something new but might be deployed immediately. And we have investments in companies that are trying to do something that doesn't exist but might actually be adopted maybe a decade from now. And what I see, the first category, typically we expect later stage investors to take us out. The second group, which is most of the time hardware companies in the energy transition, we expect strategic exits of the incumbents. And the third level, so the most innovative innovations that we have, it's typically an IPO trajectory. There is a story, there is magic, there is somewhere far away in the future, and that's great for IPOs. The example I give there, and there is hard believers and there is big deniers, so it's black and white. But one of our investments is in a company called Hard Hyperloop, Hard with DT. It's the leading European Hyperloop technology company. In the US, you have Virgin. Those two are kind of at the forefront in terms of technology development. This is a technology. I mean, a Hyperloop is like you take a tube, you pull it vacuum with 1 or 2 bar, not so much, and you put a magnetic levitation inside. So you have zero friction almost. You can go high speeds. You can almost go carbon neutral. For a new transportation modality that's very interesting, because all other transportation modalities that we have will never help us to reach the goals. But maybe this company will have a 2-kilometer track or a 5-kilometer track from an airport to a city in between 28 and 30. The real adoption, if at all, is between 2030 and 2050, maybe hundreds of kilometers of track or even more. That is very far away. It's not a technology risk, it's adoption risk. There's a lot of push from the European Union, so we believe it will happen, but it's very far away in the future. And that typically means that both the impacts, by the way, and the financial results will be after the lifetime of our fund. By the way, then you also come into disclosure regulations. We can't disclose an impact today, but we still think we should do it, because if this gets adopted, the impact is humongous. And we think as an impact investor, you should also give space to these kind of ideas. But nothing to report in the next 10 years. Yeah.
Yeah, just to comment, I think now investing from the impact perspective, I think eventually within the time frame there will be economic benefit that is being realized, and there will be an appetite from the acquirers, not for just green reasons, but for business reasons as well. So I think M&A in this space will emerge, and same for public markets.
Yeah, that's also something very interesting that we're seeing in PwC with various clients that actually now, as part of the merger and acquisition process, due diligence, ESG, especially materially related to the sector, it's a key component, because they are also like transacting to transform, and also like, let's say, not want to acquire a startup or a portfolio company that could basically like put on the wrong direction of the ESG goals or decarbonization goals. We still have time for a question, maybe if there's one from the audience. Oh, one there.
Thank you. Hans, you made a comment about your carry being affected by impact metrics earlier on. I was just wondering if you could elaborate on your thought process around that.
Well, then we get back to your question as well. So what's in the magic box? How do we measure our impact? Yeah, it's very simple. We have our proprietary framework for that. For every investment we make, we define 1 or 2 objectives together with the company related to the business plan that we embrace together for impact. That relates to an SDG, specifically to one of the sub-targets of the SDG framework. We have 5 SDGs as core objectives for our fund, so it should relate to any of those 5. And we kind of measure over time, how far we are on that trajectory. Then we also, for all investments, have one cross-dimensional objective. This might relate, for example, to equality or diversity. And climate action is, by the way, always an SDG that we have to cover. So we set up very simple goals per investment, and you can kind of, euro weight that over the portfolio and track your accomplishments over time. If we are too far behind, or we have an early exit, there are some other mechanisms, but if we are too far behind, then we start to have a discount on our carry. That does not go back to the LP in our fund, because the LP already earned its financial return. They made the threshold, otherwise we would never be eligible for a carry. That goes into a foundation that is just handing out grants for urban projects, and in that sense it will still land into society. Interesting.
Great. And well, we're conscious of the time, we're running a little bit out of time, but maybe just in 10, 15 seconds, if there's something that you think will be really great to keep an eye on, like for the next year ahead, what would it be? Maybe like left to right.
Are you thinking, or are you? Yes, I'm thinking. Oh, okay. Then I'll quickly do it, given the time. For me, 2 things that we have an eye on at the moment. One is materials and reuse. I already mentioned concrete in the built environment. You mentioned also fabrics. I mean, material science for us is really a big thing going forward. And I think in the urban environment, it comes back almost in every sub-theme. Secondly, but maybe not as an investor, what I'm sometimes missing, and there's also quite some people here that are not from startups, but are, for example, from municipalities. I think we forgot a little bit about the shared economy, and specifically the first shared economy that we had, public transport. I hear a lot about, alternatives, steps, bikes, cars, EV, whatever, logistics, but we also should embrace public transport not as a degenerated form of mobility versus the car, but an attractive form of mobility, especially in cities, and then make the other things complementary. We should prevent the city being full of these steps and bikes and not make public transport attractive enough. I'm missing that a little bit. Should be inclusive, should maybe have different lines, should be affordable. In the Netherlands, prices go up every year. In Germany now they make it almost free. I don't see one approach to how we embrace public transport, even in the European Union. So maybe not an investor approach, but a very important element in our consideration on the theme of mobility in the cities.
I know we're short on time, I'll do two just to make it interesting. I mentioned one already, which is risk pricing. I know it's super boring. People's eyes are going to roll into their head. But getting a real signal on what climate adaptation is going to cost is essential. It's going to change mortgages, it's going to change construction costs, it's going to change how we build in the built environment. And I'm frankly surprised it took this long, but it's happening, and next year for sure. We know at least one, probably Bloomberg, will have asset-adjusted pricing for climate risk, which will be a huge deal. And then the second thing is, we broke the venture market, like in the last cycle. If you can name a company that's going to be around for another 10 years that went public, I'd love to hear. Most of the companies are not going to make it. And so we think VC will continue to contract. And what that means is that we're going to have to relearn how to fund startups with other types of capital, right? And so our favorite concept for that is buy now, pay later for all of climate. So basically, how do you change most of the technology risk into a lease for customers, right? We've done that before. We did it with cars. We do it with housing. We've got to figure out how to do it beyond like residential solar. And there's a lot of interesting, basically the biggest part of the IRA in the US is this very boring idea called transferable tax equity. And the thing that it does better than anything else is it basically empowers you to do buy now, pay later as a lease.
Yeah, I think next big thing will be waste management and solutions enabling that. I think this is very much underserved in terms of funding, attention, and so on. And this will be both financially driven, but also in terms of alternatives and inputs becoming more and more expensive. There will be strong push, and also from the technological point of view, there will be a lot of underlying forces which will be driving those processes as well.
Thank you very much, and I'm conscious we exceeded the time, but I appreciate their participation. And if you have any questions, please get these guys. You'll be taken care of. Thank you.
Thanks.
Thank you very much, gentlemen, for this interesting panel discussion. Thank you for moderating, José. Thank you very much.